If you invest $500 a month starting at age 25, by the time you retire, you could have over $1 million. And if you use the right account, you'll pay zero additional tax on any of it, ever again. Not on the growth, not on the withdrawals. You already paid tax on that money once. From here on, it's tax-free for life. That account is called a Roth IRA. And if you don't have one yet, this video might be the most valuable 5 minutes you spend this year. Welcome to What is Money 101, the channel that breaks down personal finance terms that sound complicated but really aren't. Every video, we take one term you've probably heard, but maybe couldn't fully explain, and break it down in plain English. No jargon, no fluff, just what you actually need to know. Today's question: what is a Roth IRA? Let's get into it. A Roth IRA is a type of retirement account. IRA stands for Individual Retirement Account. Individual, because it's not tied to your employer, unlike a 401k. The Roth part is the important bit. It refers to how the account is taxed. And this is where most people get confused. So let's make it simple. There are two basic ways a retirement account can handle taxes. Pay taxes later, that's a traditional IRA or 401k. Pay taxes now, that's a Roth. With a Roth IRA, you contribute money you've already paid taxes on, money from your regular paycheck. But in exchange, everything that money earns from that point forward, every dollar of growth, every dividend, every bit of compound interest, comes out completely tax-free in retirement. Here's why that's such a big deal. Let's say you're 25 and you put $7,500, the 2026 contribution limit, into a Roth IRA this year, and it grows at an average of 8% a year, a commonly used long-term stock market average, though that figure doesn't account for inflation. By the time you're 65, that single $7,500 contribution could grow to around $163,000. Every cent of that growth, over $155,000, comes out tax-free, not taxed at a lower rate, not partially taxed, zero tax. Now compare that to a normal brokerage account where you'd owe capital gains tax on all that growth when you sell. The Roth IRA is one of the few, genuinely too good to be true deals the tax code offers regular people, and it's completely legal and available to almost anyone with earned income. Let's cover the mechanics quickly. Contribution limits. For 2026, you can contribute up to $7,500 a year if you're under 50, or $8,600 if you're 50 or older, thanks to a catch-up contribution. That's a cap on how much you can put in. There's no cap on how much it can grow to. Income limits. Roth IRAs do have income restrictions. If you earn above a certain amount, you can't contribute directly. For 2026, that means full contributions if you're single and earn under $153,000, or married filing jointly and earn under $242,000. Phasing out completely a bit higher. Those numbers adjust most years, so it's worth checking current limits. But for most people in their 20s and early 30s, this won't be an issue. It's not an investment itself. This trips a lot of people up. A Roth IRA is just the container, the tax wrapper. You still have to choose what to actually invest in inside of it. Index funds, stocks, ETFs, bonds. If you just put cash in and never invest it, it won't grow. Withdrawal rules. This is the trade-off. Your money is meant to stay invested until age 59 and a half. Take out the earnings early, and you'll typically owe taxes and a 10% penalty. However, and this is a huge advantage, you can withdraw the amount you contributed, not the growth, at any time, tax and penalty-free, since you already paid tax on it. That flexibility is part of why Roth IRAs are so popular with younger investors. A Roth IRA tends to make the most sense when you're early in your career and likely in a lower tax bracket now than you will be later. You want flexibility, access to your contributions if needed. You want to diversify your future tax situation, so you're not stuck paying taxes on 100% of your retirement withdrawals. It might make less sense if you're currently in a very high tax bracket and expect to be in a lower one in retirement. In that case, a traditional IRA or 401k deduction might save you more money today. That's a more advanced comparison for a separate video. So that's the Roth IRA explained. To recap, it's a retirement account where you pay taxes today, and everything it grows into comes out completely tax-free. If this made something click, do me a favor. Hit like, drop a comment with any questions or topics you want to explain next, and subscribe so you don't miss the next one. This channel only works if more people find it, so sharing genuinely helps. Next up, what is a 401k match? And why leaving it on the table is like turning down free money? See you in the next one.